it's easy to get discouraged in life. It's easy to say, woe is me, this is happening, that's happening. But look, if you just continue to get out of bed, show up, play the game, you're going to get lucky sometimes and you're going to win, right? You're not going to win all the time, but luck is where preparation meets opportunity. Opportunity will pass you by if you don't show up and play the game every day.
Welcome to the Cash Flow Chronicles. I'm your host, Johnny Catani, and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Johnny Catani, and I'm joined today by Chad Sutton. His journey with real estate began when he and his wife purchased their first home in the 2015 sizzling Nashville market that almost priced them out completely. They were fortunate to find something well below market value and performed a live-in renovation on it. After reaping the rewards of sweat equity, the neurons in his head connected the dots and led to his pursuit in value-add real estate investing. As he began to scale, he discovered that large real estate assets were valued on the income they generate, not using comparable method as the residential world. From there, he was hooked. Chad, welcome to the show.
Hey, man, happy to be here. Thanks for being on. And yeah, man, let's have some good conversation today. What do you say?
Absolutely. Looking forward to it. So we gave a little teaser there. You obviously have, quite the resume at this point. So take us back before 2015. What were you doing? What was life like? And what kind of led to where you're at now?
Yeah, I appreciate that offer there. So look, guys, I was a W-2 income worker, just like many of you out there. I had something I was really good at. I played with Legos, erector sets, and was good at math as a kid. So the world told me to be an engineer. I became an engineer, right? Went through all the schooling, thought I was that much smarter than everybody else. You know, I'm smarter than the average bear, but I mean, there's a lot of brilliant people who are not engineers, so we'll leave it at that. But look, I went to work for some major corporations. I worked for the government by the way of NASA back when the space shuttle was still flying, got to work in combustion dynamics and all the things that go boom and smoke and fire and stuff like that. That was really fun while it lasted until around the 2008, 2009 timeframe when guess what? If the, when the economy wasn't doing well, we decided not to play in space anymore. Right. So graduated school in engineering school, you kind of work while you're going through school. So I started my career concurrently with college. Anyway, I went to work for a little company called GE. You guys might remember them. Spent several years designing aircraft engine combustion sections. So the area where the fuel is burned, did a lot of really cool testing there. And if you fly at all on a commercial airliner, and some of you military pilots out there, I probably touched your engine at some point. So that was kind of fun. Got to make, big toys that go boom and go fast and stuff like that. Until I looked down one day and I found myself, having designed 3 different engine platforms with a massive team. It was not just me, granted. And I had 3 patents to my name, one of which really helped position GE into a multi-billion-dollar market share position. And I got a little slack upon the butt and $1,000 and maybe a 3% raise. And they're like, attaboy, go do it again. And that's kind of where I started to realize, wow, you're only going to get paid what, the market says your job is worth and how hard it is to replace you, right? So that's an Earl Nightingale quote. Your rewards in life are commensurate with the degree of difficulty of what you do and how hard it is to replace you, right? So that kind of opened my eyes. I despecialized around the time when GE's stock price went from like $50 to $5 overnight. Y'all remember that? Or over a couple of months, we formed an internal team. And my whole job for 3 years was to fly around the world on the corporate Amex, which was great. Got to see all sorts of, Asian, Scandinavian, European countries, places like that. And my whole job was to go and figure out how do we manufacture our big industrial products cheaper, still have the same, performance and quality, but, improve the bottom line, And so that was P&L experience, profit and loss experience. That was manufacturing, that was engineering, that was culture change. Imagine walking in after someone who's done something for 20 years and ask them to do something different, right? So got a crash course in business over that. It was really awesome opportunity that led to a global commodity leadership role where I was in charge of all of the spend for the wind turbines in the heavy electrical sections, all the big switch gears, big transformers, really big stuff. And my whole job, Jonathan, was to literally take our suppliers, bend them over the table and take everything from them. And I was good at it, So it was hard, morally misaligned, this is where the other train kind of catches up to real estate, and then I'll stop there. So, I eventually got burnt out on that because, man, I was really good at taking things from other people. And for me to win, others had to lose, which really hurt. I'm actually a third generation investor, unbeknownst to me until I was about 28. So my grandparents had amassed a large portfolio of single family rentals. I worked on them as a kid. I just had no idea they owned them. I just thought it was their job, and they didn't talk about it much. Granddad passes away, and we can tell an anecdote about that later if there's time. He's a funny guy, but big Texas boisterous man who taught me a lot of what I know about life, passes away in 2016. Big moment in my life. And my aunt and my mother, who are sisters, of course, are the second generation real estate investors. They took over the company. My grandma was in retirement. They took over the real estate business. Well, this is around the same time where I'm asking questions like, how do you get wealthy in this country? Because working for GE ain't it, right? I'm paying high taxes, getting little raises. Anyway, and it seems like more and more responsibility and work for not as much money, right? So that was the challenge. And then, we tried to replicate the single family business in my state and decided, wow, the pound for pound doesn't really work here for what you have to rent these for and buy them for. It just doesn't work. Started studying, figured out the macroeconomic imbalance in housing. It's a supply and demand problem. We are short 3 million single family homes now and 1 million in closing, but still 1 million rentals. We have a perfect storm for rental real estate for a long time to come. So that got me hooked. Bought a few real estate properties or a few multifamily properties because we knew residential, and that seemed to be the best asset class for growth. Did a few ourselves. People started asking how they can invest with us. We had to figure that out. Apparently, there's something called the SEC that's not the Southeastern Conference, and we had to learn how to play nice with them. They're a lot scarier, by the way.
Yeah.
But anyway, learned how to raise money, and we now control as Quattro Capital right there behind me about 200 million in real estate assets that are moderately leveraged, poised well for this downturn that we're kind of experiencing, and we're salivating at the helm for opportunities to come.
I love it. Wow, that's quite the story, and I love that you told the whole kind of GE story because it's important to know, like you mentioned, that, even getting high up in these corporations, right? It's still trading time for money. Like, yep, it's nice getting that big salary and those bonuses, but you're still trading time for money. You still work for someone else. Like you said, you've got your name on some patents and didn't get nearly worth what they should have been worth. So I like highlighting that because I want my listeners, I believe everyone can do what we do, right? And it's a little bit different path for everyone, but it's important to highlight that. So I love it. So let's get into now, obviously you learned about the SEC, can't mess with them. I was a licensed stockbroker. You'd never want to mess with them. Nobody knows what they do, and they never take blame for everything, but they will ruin your life. So that's just kind of hyperbole there for our entire government. So talk to us about you got into multifamily real estate.
Yep.
How come you never talk to us about the debt side? How come you never use any kind of bridge? Where did you learn to use good debt and good financing? Because that's something I talk about constantly because obviously we're faced with that issue right now. So kind of touch on that, why that was your goal and, how it's worked out for you guys.
Yeah. And, I think the first thing I'll say is there's no bad debt. Well, that's a funny term. There is bad debt. It's when people don't pay you, but there is no bad debt product. There's only bad debt risk mitigation. Okay. Fair. So think about it that way. We are very fortunate to know that we don't know what we don't know. And so when we got started in this business, we made sure to establish a board of advisors, and the requirement for that board, you've seen a few cycles, you've been in real estate, you have different aspects. So we were able to get some crash courses and kind of like, hey, here's, history doesn't repeat itself, folks, but it damn sure harmonizes, right? It kind of rhymes. And so the thing you have to recognize, and this is stolen straight from Tony Robbins, pattern recognition, pattern utilization, and ultimately pattern influence, right? You get those three things right, you can write your own ticket. But the first thing is recognition. Well, if you think about how people get in trouble with debt, well, really with real estate, it's you run out of time and you run out of money. Those are the only two ways. Everything boils down to running out of time or money. What does that mean? If you have short-term debt that's coming due at a very inopportune time, like right now, it's not great if you have debt coming due right now. And I do, and we'll talk about some of that, but I've mitigated that risk. You're out of time. You have to make a capital decision, and the market may or may not be in good shape when you're ready to do that, right? You run out of money. That means, okay, maybe you took a variable rate loan, you didn't mitigate the risk, and now your rate's 2x what you thought it would be, or at least 1.5x, and you're bleeding out. You eventually run out of money, right? You have to put more money in or you're done. And so, the simple way to think about it is debt is like tools in a toolbox. You have a screwdriver, you have a hammer, you have a drill, right? And, you can't necessarily use a hammer at night because you might smash your thumb. You need to use a drill with a light on it, right? And so you got to think about what to use at the different time. And so, yes, we've used bridge debt. We've used a mixture of bridge debt, variable floating rate debt, agency debt, bank debt, life company debt. It just depends on the project we're doing, right? We've even used CDFI debt, which is like Community Reinvestment Act for banks. It's like, if you can qualify for it, it's super good money, right? But you got to think about this in two ways, right? If you're going to use floating rate debt, what's your biggest risk? It's not rhetorical. It's floating rate debt. You don't know what it can be. It's uncapped. So what do you have to do? You have to make sure you have longevity so you don't run out of time. That means get a couple of extensions on it. Make sure you can qualify for the extension hurdles and come hell or high water, right? So every one of my bridge loans has somewhere between 4 and 5 years, right? All in. It's going to cost you a fee to get there, but as long as you know the property will perform at that level, good. There was a huge property foreclosure, which the Wall Street Journal just put out an article on this, and I'm pissed about it because the way they spun it was like, oh, big bad syndicator is losing your money. Like, no, Blackstone is having the same problem as the syndicator who got foreclosed on. The reason this guy got foreclosed on is he used high leverage floating rate debt, like 85% loan to cost. He was up to his eyeballs in debt. He saved money by not purchasing appropriate rate cap insurance. This is a hedge product. So what does that mean? When you have a floating rate debt, there's an index that floats over time, and the lender will usually give you a spread or an adder over that index. So let's say it's SOFR. SOFR moves over time. LIBOR moves over time. You might have a spread of 300 basis points, 3%. So if SOFR is 0.5, your rate is 3.5. Well, that's great. Problem is people didn't think about the fact that rates are at historic lows, and sometime over the next 5 years, it's going to freaking go up, right? It just had to happen. It's physics. Go study the data. We can talk about that. History rhymes. Well, if you don't buy a cap, a ceiling that kicks in when that gets above a certain point, we were buying 1% ceilings before it was cool. So if I have a 300% spread or a 3% spread, 300 bips plus 1%, my max rate I'm paying is 4%. I don't give a shit. I'll pay 4% all day long, right? Or even 5% if I bought a 200. These guys were buying the minimum the lender said. And so their cash flow is getting so depleted because their rate went to 6, 7, 8%. And if it's uncapped, 10%. That's a big problem when you started at 3%, right? And so this is why if you're going to use floating rate debt, you have to make sure you never run out of time or money. How do you do that? You make sure you have enough time on the clock to get through. I mean, if you give me 5 years, I'll probably get through a period and be able to refinance that loan. And if I mitigate that hedge, mitigate that interest rate risk, it's no different than a fixed rate loan to me, right? So that's kind of how we think about it. We're always thinking about how do we mitigate our risk? And if it's floating, fix it. If it's fixed, good. What's your timeline look like? And look, don't lever up to your eyeballs. I think we're average, 62, 65% loan to value across our portfolio. You got to raise a little more money, but the difference in equity and debt is staying power. If you maximize debt, in theory, you maximize earning power if nothing goes wrong. But if you minimize debt all the way, then you kind of minimize earning power, but maximize staying power. If you bought the whole thing in equity and not debt, you can never get foreclosed on, but you're not going to make any money. So there's an optimum balance there where you figure out, okay, what's the optimum of staying power and earning power, right? You don't want to go too far off the cliff to where one thing goes wrong and the whole deal blows up.
Wow, that was incredible insight. I really appreciate that. Very in depth. I can tell you're obviously very knowledgeable and very passionate about it. And yes, so many great points there. I love also that you were buying rate caps before it was cool and they were inexpensive, right? Which is a very inexpensive way to not have to, like you said, to by basically your staying power, as opposed to, as rates start to go through the roof and you're almost forced to buy them, and they're 10, 20x what they were before, and then they're killing deals. And like you mentioned, the foreclosure you talked about, is that the big one down in Houston, or is there another one?
No, it was the big Arbor foreclosure of about 3,300 units. And there was actually there's a Wall Street Journal article that broke today about that individual. And it's just, it's sad because now, granted, the guy
on the individual himself. Okay.
On the individual himself.
Wow.
So the sad thing is, yes, the guy lost a lot of people's money. Like he's in trouble, right? He did not have good risk mitigation techniques in place, but the Wall Street Journal's take on it was, this is what happens when you invest with the little guy, like almost using fear tactics to push you back to Wall Street. It's like, folks, don't let that happen, but learn from the guy's mistake, figure out, okay, what risk did he overlook? And look, Blackstone, again, is having the same problems, right? Not because they're not smart. They're well capitalized, so they can, probably handle it in cash, but you can't be uncapitalized and make poor risk mitigation situations, because then you're going to run out of money, right? So
absolutely. Yeah, couldn't agree more. And so has anything changed in terms of your guys's, obviously you guys are, like you said, you did a board of advisors, obviously there were, a certain threshold to be part of that. You mentioned going through different cycles. So you've done all the right things. Has anything changed in terms of your investment thesis or kind of approach? Or are you, because of, kind of staying on top of these things, is it still obviously probably a little bit more conservative, not as many deals, happening, but has anything significant changed for you guys?
Oh, absolutely. And folks, the market moves in cycles. This is the nature of having fiat currency, right? Which is a whole topic we can go into, but the market moves in cycles. And some are short-term cycles, some are long-term cycles. If you don't understand what I'm talking about, Ray Dalio has a great video about how the economic machine works on YouTube. It'd be the best 30 minutes of your life to understand short-term and long-term cycles. The point is we're feeling a long-term debt cycle, and we've also felt a couple of short-term cycles in like 3 years, because we had an event called a pandemic, which I'm sure we'll get into, and all the stuff that has caused. It's a cause and effect relationship. So look, back in the late 2010s, we were still doing some of the C-class apartment buildings, which is, some of your really old 60s, 70s stuff. But, look, you could still buy it for a better price, pound for pound, than you could an A-class property or a B-class property, right? So you were compensated for that extra risk. Well, towards after 2020, those cap rates all got on top of each other. It didn't matter if you're buying an A-class building, a B-class building, an F-class building, a C-class building. It was all 4 caps, mid 4 to 5, doesn't matter. So, the conventional wisdom, well, gee, if I'm paying the same pound for pound price, why not buy a better asset? So it no longer made sense to do those higher crime, lower income situations where you can really clean up the community and build a better mousetrap for those people that live there. So we started focusing on your mixture of blue and white collar, upper end, B-class buildings. And we focus on those in areas where they can be renovated to, that there's a really big gap between Class B multifamily stuff built in the 1980 to 2005 and stuff built after 2005, which is kind of has still stayed up in the high A class range. There's a huge gap. Like we're talking, if B class are average of $900, A class is average of $1,500, right? There's like a $600 gap. So in our minds, we are, repurposing old housing and filling that gap, old made new, but filling a niche gap where maybe young families, young white collar workers, upper end blue collar workers, that they need a place to live that's not old and decrepit, but also not brand new. And so that strategy has worked very well for us. It's a very stable resident base. Who's the first to lose their job when a recession comes? Just remember the pandemic. What were the first ones to get laid off? Service workers, factory workers, all the hourly jobs. Our people just work from home. It was fine,
Right. Yeah, I love that. And a really great point too. And one thing I've been talking about is really forming that investment thesis and being able to stay nimble, right? Like not honing in on one specific thing, because you've got to be able to navigate and understand what the market is giving you. And obviously you guys are clearly, using that same method. Now, you mentioned a little bit earlier, there's some things. Are you in hot water in anything? Have you, is anything going, like, kind of touch on, when you do all you can to mitigate and things, can still go wrong, kind of touch on that and what you can do to get through those.
Let's talk some of the good, the bad, the ugly, right? And so, interest rates can't go up 5% in 1 year and nobody feel it, right? So like if you made really poor risk mitigation decisions, you're feeling it bad, right? But even if you made some good ones, you're probably like making some adjustments right now. So look, we have 8 bridge loans across our entire portfolio of about 28 buildings, right? 4 of them are fixed rate, and those are the ones I'm dealing with this year. So they were small bridge loans, fixed rate. We leveraged them below 70% loan to cost when we bought the deal. So, and the good thing is for those 4 deals, we bought those all at really good basis, right? You hear this all the time. You make your money when you buy, right? Mm-hmm. We still felt like we were overpaying for them, but the basis was really good compared to where it is today. So we've made progress on all the buildings. We've hit our rent projections. We've done renovations. Things are a little over budget, from the supply chain, revolution that we kind of felt in the last couple of years. We'll just say that's a whole nother topic. But the good thing is, I've already refinanced one of the 4. It kind of hurts that we had to do a 6.5% rate at the time, because that was in February. So, what do? You don't go after an agency loan if you're at the top of the rate cycle. You go after like a medium-term bank loan. You just stabilize for a little while and you wait until the rates are a little better and you try again, right? So, but the point is, we wanted to get out of that loan. It was not a lender we were really crazy about dealing with. And so we wanted rid of them. So we moved that to a bank loan. That's done. We're working on loan number 2 right now, which that one actually is ready to go to agency. And now that the treasuries have so the short-term rate is really, really high still, but the medium and long-term rates are kind of approaching normalcy. Like I'm at about a 3.4, 3.5%, 5.7 and 10-year treasury bill. That's not that out of the ordinary.
No.
And I remember back in 2019, I was originating debt at 4.75 and I was happy as a clam about it. It was before we ever thought about 3% debt. So we're actually taking that one to agency right now. And again, we bought it well enough and we've done a lot of work to it that, we're going to it's going to be about 60% LTV. That's about what you get right now is 55 to 60 based on debt service, but it's a good loan. We're going to take out, we're going to get rid of the 4.75 million and go to about a 6.5 million loan, give some money back. It's going to be good. The next 2 are similar stories. We might extend those. So, again, you never run out of time or money. So we're well capitalized. You have the ability to extend if you decide the refinance isn't the right time yet. So we have that lever we can pull. So I'm not sure about those 2. Now, the next 4, those are bigger bridge debt fund loans. And, they're going as well as can be expected. So what's the challenge that no one anticipates? When you think about a debt fund, not a bank, a debt fund, right? So we're talking about the Greystones of the world, the Laments of the world, the people like that, right? Who raise money from investors and lend out debt. Well, the way they do this is they lend it out of a big credit line at a bank. They have kind of a warehouse clearing line. And what's happened, right? The banks are kind of, the ice has started to crack a little bit. And we can talk about why I think the Fed's done raising rates on that. But some I'll give you a little conspiracy theory on banks too, which is fun. But anyway, the ice started to break. And so one of the banks that failed was a big real estate lender, right? That all of a sudden put a lot of scrutiny on the debt funds who were using that clearinghouse line, right? So what's happened? Even though we're performing well on all of our assets, and even though we are, above or at plan and everything's going well, guess what? Our construction draws are now taking, instead of 2 to 4 weeks, 2, 3, 4 months to get back, because you have to do a dissertation to prove the work that was done. They come back and want to tweak stuff. They send out three inspectors. Like, it's just taken a long time to get it back. So what does that mean? Folks, your cash is king. And they say that for a reason. When you go spend $2 million in construction and you don't get it back for 4 months, well, that hurts the cash you can spend on the next thing, right? So if you have bridge loans, draw early, draw often, lots of little draws. Don't send big draws, right? Do little draws and just keep the money flowing, because it's going to take more time right now. So that's, the loans aren't in trouble, but that is like it's a pain in the neck, because it kind of strains the cash to be able to go faster and do distributions and all that kind of stuff. So that's something to be aware of. And then the next thing is, A lot of these loans that were originated, if they're coming due right now, I hope you have enough equity. If you have enough equity, you'll be fine. If not, you may be writing a check, is what it is. But or extend it if you can. But the good thing is that a lot of people have bought good rate cap hedge insurance, and the challenge is going to be when those start coming due. So look at your debt portfolio at least 12 months out, know what's coming due, and start preparing the asset. If you need to take it to agency or take it to a bank or whatever, get it ready for that. If you need to buy another rate cap, get ready to buy another rate cap. The good news is, the world is pretty much convinced that rates are coming down in the next 2 years. So if you have a hedge coming due in the next year, you're probably going to get a pretty good price on it. So it's not all rainbows and unicorns out there, but folks, just manage your debt portfolio. Your debt is an asset. Manage your debt portfolio just like you do your assets.
Absolutely. I love that. More really great insight and a perfect segue here. Let's kind of transition into, pull out your muddy crystal ball here. What do you see coming? Do you foresee the Fed pausing here in a couple weeks? And kind of give us your 12, 24-month outlook.
Yeah. And look, these aren't Chad's predictions. These are Chad looking at all of his mentors and data providers and all that kind of stuff and forming an opinion. And so, like I said, I may not have been around for the last 3 cycles, but I know people who have. I talk to them regularly, and I try to overlap everything that they're saying. And so the thing we have to remember is how we got here. Let's just remember, and this is, talking about Dr. Peter Linneman's research. If you don't have this, go check out the Linneman letter at linnemansssociates.com. Great data. We use it quarterly. The summary is we shut down the world for the first time since Noah's Ark, y'all. I mean, it's been like we've never done that. And so we created a massive supply chain imbalance. Well, that created inflation because all of a sudden you had no things that were made and people wanted to buy things and you couldn't get things. So prices went up, right? That's what we had. It was not, a systemic problem with the currency. It was a 100-year, 500-year event we've never done before, right? Is what it is. So we had inflation. Fed waited way too long to bring rates off of zero. And so we kept going gangbusters and spending money because it was free, right? Kept taking on debt up to our eyeballs because it was free. And like you were stupid not to. Well, then we had to make an overcorrection and go 5% in 1 year, which, is going to break glass somewhere. It's like bull in China shop type of economics. Think about driving a performance car. And again, I'm quoting Peter Linneman here. Driving a performance car, a Lamborghini on a test track with perfect traction tires. And it's going to be tight. It's going to handle great. That's what the Fed thinks they're driving, right? In the U.S. economy, when actually they're driving a jalopy with bald tires on a sheet of ice in a snowstorm. You can't see, you're spinning around all over the place. And so what do? You jerk the car over to the right. Well, to prevent hitting the guardrail on the left, you're gonna have to jerk it right back to the other side, And so the problem that we're sitting at is we've jacked rates way too far. We waited too long, and we've started to break glass in the banking sector, mainly because, when a lot of the banks listened to the Fed when they said, hey, we're not going to move rates fast. So they put a lot of money in long-term securities like bonds, the bond market. Right. And then it was, oh, never mind, we're going to do this. Well, now to stay solvent, they've had to sell those things at a massive loss. Enter SVB, right? And think big picture for a minute, little segue. We have this whole cryptocurrency, thing going on, right? And I've never gotten into it. I've always said, look, it's great. People are treating it as an asset. They're buying it like a stock and selling it, buying it low, selling it high, making money. Some are losing money, right? That's stock behavior. That's not currency, right? Until I can go buy my groceries or until I can buy a car, I guess I can buy a Tesla, but get my point. Until I can trade and live on it, it's not a currency. Right. We're still mandated to trade on the US dollar. And so I've always said, look, the Fed, we say their first job is to do no harm and to keep inflation low. No, their job is to protect the US dollar. And we can get into some anecdotes on that of what happened when an oil line blew up that magically was appearing between China and Russia, right? So the point is the Fed wants to trade in US dollars and we want to stay as the international reserve currency, right? Well, what was threatening that? Cryptocurrency. Imagine if you start drawing links, all of a sudden, FTX was, the SEC filed suit on them and an event happened that caused them to go under. That was threatening the SWIFT, the International Monetary Trade platform. Then you see SVB go down, you see Signature go down, you see, I forget the other one, but the other bank
First
that went down.
Republic.
Yeah, First Republic went down. Most of them big in crypto. So you start to see that the Fed will take down whoever they need to make sure the dollar stays warm. So anyway, so I think segue, but I think that or not segue, but squirrel. So I think that we've kind of gotten to the point where we're busting against the ceiling of breaking the banking system. The Fed propped up the banks that failed and didn't let anybody lose their money. Otherwise, we'd had a massive 2008 catastrophic bank failure. So kudos to them, but they eliminated some things and did that. And now, if you go to fred.com and just plot the Fed funds rate since the beginning of data, right? Overlay on it recessions, and you're going to see this nice up and down behavior. My friends over at Pensford, another information source of ours, they are on record saying, look, if you look at the data, and I have, within an average of 2 years and a max of 3 years after the first rate hike comes the first rate cut, ever since the beginning of the Fed. And so, and you guessed it, when the rates go up fast, the cuts come fast. When the rate goes up slow, the cuts come slow. So that's your average of 2 to 3 years. The Fed's been on the clock since the beginning of 2022, y'all. They started raising in 22. We're now in 23. So by my watch, we are somewhere between 2024 and 2025 to reach some normalcy on rates. And it may come in 2024 or late 23 because we've pushed them so far so fast and started to break the banking system, right? So going back to do no harm, if you actually look at we don't care about year over year inflation. We use that in the news to talk about it still being high. Well, of course it's high because the housing metrics, which makes up like 40% of inflation, this is a known thing, y'all, makes up 40% of inflation. It lags by 6 months. So the data we're looking at is 6 months old, right? That accounts for half the inflation index. If you actually look at what is happening month over month, like we care about month over month, week over week, day over day, what's happening? We're already normal. We've already stopped. It has stopped growing. So we don't need to keep raising rates. I don't think that they will. And further, I do think by the time we get into 2024, we're going to probably reach a steady state where, your all-in rate on real estate is probably around 5%. Maybe upper fours if we're lucky. That's not bad in the history of interest rates for real estate, So hold on. Our mantra right now is survive until 2025. Deal with what you have to today, marry the property, date the rate, all those little sayings. But I think we're going to be okay. The macroeconomics, remember the macroeconomics. We are 3 million homes short on single family, properties to live in. We're 1 million short and closing, but we're 1 million short on rental houses. That means you're 1 million short on rental housing. People are going to pay higher rents. You're 3 million short on homes. People are going to rent longer, which means occupancy stays up. It's a good storm for multifamily to be in. And, when it comes down, like think about it, if gum got too expensive, right? You'd stop buying gum or you'd go buy a candy bar. If homes get too expensive, you still eventually have to buy a home. You outgrow the one you're in, like you still have to do it. You know what I'm saying? And so in general, I don't see a big crash coming. Probably 40% of home buyers who have a mortgage, they locked in sub 3% rates for 30 years, right? We don't have a massive default coming. There will be pain like the one that I discussed in the Wall Street Journal article, unfortunately, for those who did not manage risk well and may not be able to execute on their business plan. So that's going to be, there will be some of that. Don't let the fear get to you. We're going to be fine. Just survive until 2025, keep occupancy up, and you'll be fine.
I love it. Really great insight. Any concern with the debt ceiling issue? Obviously, neither side wants a default, so I do believe something will be reached. It's looking like it'll be in the 11th hour, but kind of give us a quick comment there.
Yeah, and I hope I don't quote the data wrong, but I did look at this recently just for fun. The amount of debt held internationally and not by our country is like 15% of our total debt. So it's like, and look, think about what debt is for a lender, folks. Debt is an asset. You got to flip that in your mind. But for a lender, if I lend you money, that's money I'm giving to you. And further, it's not even my money, because if you're a bank, it's someone else's money you're lending out. Well, they don't want that money back. They want the payments on that money, especially if it's a massive loan in the trillions of dollars of range backed by the U.S. government. right? What other government, I mean, you can argue some of the other political superpowers, but what other government, what other economy is tried and true in the world? No country is going to call our loans due. And if they do, it's a political stunt. This is a political stunt. It's theatrics. We will never let I think we like shut the government down out of principle, a couple of years ago when this happened. The whole point of this is each side who has control, they always wait until the car runs out of gas. They have to get out. They have to negotiate with the other side to bring them a gas can. They put more gas in, they keep driving, but it always comes with concessions. So this is nothing more than a stunt by either party. I'm not being political favorite here. Either party will pull this stunt. They've all done it. They will try to extract concessions out of the other, and they'll publicly make it look like, oh, the Republicans or, the Democrats are going to make us default on our debt. No, they're not. No, they're not. And further, debt is a good thing, because the way our currency works, it's fiat currency. Every time you put $1 in the bank, they lend it out 10 times, right? It's called fractional reserve banking. That's the reason banks can fail and have a run on a bank, is if they've lent out your dollar 10 times and you want your dollar back, and everyone wants their dollar at the same time, there's not enough money, right? It's a difficult concept for another day. The point is, they don't want the debt to go away. And if they did, it would be a massive global economic crash, because 90% of the money would dry up, right? So it's I'm not worried about that at all. It's a theatrical stunt. It always is. The other side will make some concessions and we'll move about our merry little way.
I love it. Yeah, that's I share that same sentiment for sure. So, obviously keeping an eye on it, but yeah, a lot to take in for sure. But like you said, we're going to be fine, right? We're in a cycle. We always go in cycles. You look at history. I love that you said history is harmonic. That's a really, really great point, because, we're just not in, I just feel like the last couple of years, we hit the top of that cycle so fast, right? And then tried to come back down so quickly, like you mentioned with the Fed and everything. So it's got a lot of people kind of scrambling, and there's fear, but, really great insight to just survive to 25, relax, don't over leverage, and we'll be all right. So I love it. Cool. Let's go ahead and wind down here. We'll jump to the final 5. First question, best advice you've gotten from a mentor?
Best advice I've gotten from a mentor, man, that's tough. I have a lot of good mentors, a lot of good advice. Caught me off guard with that one. Honestly, I would have to say that the best advice I've got from a mentor is to show up, kick tail, and repeat the next day, right? And so it's like, it's easy to get discouraged in life. It's easy to say, woe is me, this is happening, that's happening. But look, if you just continue to get out of bed, show up, play the game, you're going to get lucky sometimes and you're going to win, right? You're not going to win all the time, but luck is where preparation meets opportunity. Opportunity will pass you by if you don't show up and play the game every day, and you won't be prepared to capitalize on it anyway. So get up, well, I'm going to unedit this. Get up, kick ass, repeat. Okay. That's the best thing you can tell yourself.
I love it. Absolutely. Huge. What is it about your career that makes you feel like you're fulfilling your why?
Yeah. So we alluded to this earlier, in my corporate career, at the end of it, for me to win, others had to lose, right? In my current career, when I win, everyone wins. My investors make money and grow their wealth. My family, my team, we win, we grow our wealth. My residents win because we are in, typically we buy communities they have some sort of a problem. We fix that. We revitalize it. We improve the community. The people that work for me win. I'm creating lots of jobs through construction and operations and all sorts of stuff, right? Nobody loses when we win. The government even wins because we're doing something they suck at, and that's creating, housing by repurposing the old stuff and not having to build everything new. So everyone wins when we win, Jonathan.
I love it. Absolutely true. That's one thing I love so much about this industry, that abundance. Favorite non-real estate or investment related book?
Non-real estate or investment related. Wow, that was tough. I've read so many. I would have to say that I'll give you 2, because one is a mindset book. It's called The Honeybee, and it's kind of a spin-off of the Rich Dad, Poor Dads and Richest Man in Babylon's, but my friends over at Jake and Gino wrote it. And it just had a great story about an individual and his wife who are navigating through, the tries of early investing and entrepreneurship and ultimately life decisions. So it's more about life, but it has like that sprinkled in there. That's a great one. And if you want a good education, it's really, if you're going to invest at all, you have to understand how money works, right? And there's a great book called The Creature of Jekyll Island.
I love that book.
It's about that thick.
Yeah, it's
You can
Bible.
listen to it, you can read it. It's a big one, but I'm telling you, if you're not really buying in or understanding what I'm saying about the Fed and interest rates and fiat money and banking, you need to read it. Now it's a little dark of a book, but the point is not woe is me. The point is you can't freaking play the game of Monopoly if you don't know the rules,
Right.
know? So learn the rules and you'll play the game better.
Correct. I love that so much. Such a great point. If you could have any superpower, what would it be?
Oh, I'd fly.
Yeah,
Definitely.
Heck yeah, definitely. Love it. Cool. Last one. What's the best way for people to get a hold of you and learn more?
Yeah, folks, reach out to me online, chadsutton.info. That's CHADSUTTON.info. That's going to have everything from the Real Estate Runway podcast to the Quattro Capital website to the investments we do to articles we put out. Anything value add that we do, you can find at that link, as well as my contact information. I love talking about this stuff. And, people helped me, people gave to me. I'm always happy to talk to you. So pay it forward, do the same.
I love it. We'll link that in the show notes, make it super easy. Chad, we could honestly do this for the next few hours. I love it so much. Thank you so much for all of your insight and your time. We really appreciate it.
Yeah, Jonathan, thanks for having me on. Look forward to doing it in the future.
Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to KataniCapitalGroup.com to learn more.